Well, thank you
Right.
everyone for joining us this week for Mortgage Matters with Chris here. Um, we are excited to talk about this topic, another new one. So, thanks to our friends for tuning in, those tuning in live, and then, of course, those tuning in on YouTube as well. Chris, there are, from the outsider's perspective, there are so many loan programs, and they've all got names. And I guess that's a good thing why we do these,
Yes.
because like someone's got to clear it up, because otherwise you get thrown all these like loan program names and it's just like they all get jumbled up. So we got another one, newish, and or not necessarily a new concept, but a new program, I should say. The debt service, am I saying it right?
Coverage.
Ratio loan.
Debt service coverage ratio.
I work with you, and I get the names of them
There's
jumbled
a
up.
lot of little acronyms. I mean,
Yeah.
most people just call it the debt DSCR loan.
Yeah, and this is another one of those niche type programs that for those who qualify for it is very beneficial. So, yeah, excited to jump in today.
Yeah, so great. So I mean, this program is perfect for property investors. A lot of times what happens is, people who own a lot of properties, they and their income is coming from their investment properties. Once you look at their tax returns, sometimes there's not enough money to add even back based on repairs that they're doing with these properties. And sometimes it's difficult to get them financing for what they're looking for. With this program, it's a really great solution for people that may not have all the money they need to buy the properties, but they have a great plan and they have a great property that could generate the income that they need. So what the product allows is investors to qualify for the loan based on the subject property through the debt service coverage ratio rather than a traditional, income verification or a debt to income calculation.
So can
We call it a
you tell
DTI.
us what a debt service calculation is and how that differs from like a normal DTI?
Well, first let's go back to talk about, with the traditional loan, what most people try to buy an investment property, say through Fannie or Freddie, they put 20% down. They have to provide their tax returns and, they're qualifying based on the income that not only they make, but also they can use the rental income that the property makes. And in some cases, yes, that works. But in some cases, based on, tax law and the way people can write a lot of money off on the money that they spend into some of these investment properties. So debt to income, traditionally is speaking, is what someone has coming in the door versus what's going out. And what I mean by that is let's just use a really round number of $100,000 a year income. Someone who makes $100,000 a year is somewhat around $8,000 a month. And say in a traditional loan program, you could go to 50% of that income, right? So that would mean out of the $8,000 a month, we would have to keep all revolving debt, which are your credit card bills and all those kind of things. Your installment debts could be motorcycles, boats, cars, anything that's an installment type style debt, and your housing expenses. And when I say expenses, it could be the home that you own. You could also own a second home. You could also own an investment property. And included in that, sometimes we can use the rental income that the investment property brings in. But through and through, we can only keep all the debt under that $4,000 a month. Traditionally, that's your debt to income. So if you're spending, let's just say on a very high level, $1,000 in revolving debt, $1,000 in installment debt. So 2 car payments at $500 a month. And that would have to allot your mortgage, your home to be under $2,000 a month. We would then be at 50% debt to income to qualify you for that house. Well, in most cases, when you have a lot of property investors, sometimes the write-offs that they have just outweigh the income that's coming in the house, which would then prohibit or stop them from qualifying for, a traditional loan style. So what do? What people have been doing in the past is they go to hard money lenders. They can get very expensive. There's a lot of charge and cost up on the front end. The rates are higher. And in a lot of cases, people don't know who those private investors are, right? So an opportunity for somebody like maybe a person that doesn't have these connections or these relationships with people that can get them to these, hard money lenders per se, we are an option for them, right? Someone like us, other lenders out there that are working with investors that
Oh no.
money and then offer this program out there, property on there. And the money that property generates will qualify them for a loan. And am I still unstable, Mindy? Because
It froze one time, but you're back now.
okay, all right. I just seen that pop up on this, so I want to really be really tight and specific on what this means. So, I buy an investment property. I pay $500,000 for it. It's 3 units in the building. My mortgage on that $500,000 property with taxes, insurance, any MI or anything else that there's no MI maybe with it, but whatever other costs associated with that building is, let's call it $4,500 a month. So, however, each unit, let's just say they're 3-bedroom, 2-bath units, right? Each unit of that property is bringing in $2,000 a month. Well, 2, 4, 6,000, and my mortgage payment's $4,500. Well, this house is actually profitable, and the rental income will support the debt. So in that case, I can buy this property based on the property supporting the debt. The rental income, the market rental incomes will support what that debt is, and that's what's qualifying this loan. The other piece of qualifying for it is you also have to have some good credit. You have to have good credit as well. You can't have horrible credit and just come to this. So we do look at you because we want to know that you have the ability to repay back the loan. So the key to getting a debt service coverage loan is you have to be, if you have a solid business plan with this property and the market rents are what they are, and then you also have a good credit score, because a lender wants to know that you're a good investment for them as well, and that you do have ability to repay a loan because you pay all your other loans and you're a good steward with your money, so to speak. We look at those two things. The other nice thing about it is similar to your regular traditional investment loans. You have to put 20% down. You have to put 20% down on this loan as also. In some cases, there are some points on the front end, but also right now in the climate of this market, when you do a traditional mortgage with Fannie Freddie, in a lot of cases, you're paying upfront money as well to close on that investment style loan. So a couple things that make this program a little easier is a lot less paperwork, right? You're not chasing down. So say you're a big investor, you own 10 properties, 8 properties. Well, on a traditional loan, you have to provide every tax statement for each property, every town tax or city tax bill, every insurance binder. So we got to calculate all your costs associated with that building, not just a mortgage statement if you have them, but every other additional cost. And sometimes that can get tedious for a lot of these investors because they're busy doing stuff, and it's a lot of paperwork to gather. With this loan, we're just really looking at the property itself to secure the mortgage and make that property supports the debt.
Are there property restrictions? Like, does this apply to single family homes? Is it only units that have multiple units inside of it? What does that look like? So if someone's getting ready to or thinking about taking this path, what kind of property should they be looking for or not be looking for?
Any good investment property. It could be a single family home. It could be a single family multi-unit. You can buy, 2, 3, 4, 5, 6, you can buy a multi-unit family with these properties. So this is a non-qualified mortgage program, and we call them non-QM loans, which stand for non-qualified mortgage program. So go ahead.
Does a person have to already be in the investment, I don't know, industry is not the right word, but can this be their first investment property, or do they already have to have a portfolio of investments?
Great question. And absolutely, they don't have to be, that will help on the approval if they have a history of it. Obviously, that looks good to anybody who's lending the money to somebody that's buying a property. but as long as they have good credit and there's different tiers, I think the bottom is a 680. And obviously you have a 680 score. That's not a great score, guys. It's not the best score. Now you're going to go buy an investment property for 500,000. Well, we also know that you're going to put $100,000 down. You have some skin in the game, right? However, there is a risk layering because you don't have that optimal 740, 760, 780 score. So you're going to probably pay a higher interest rate. Which then you better have a pretty good deal on the house too, right? Because we got to make sure that it is going to be profitable at the end of the day. So those are the things that we're going to look at is, are you still going to be cash flow positive after you buy this house for 500,000? Now, maybe you buy the house for 500,000, you're only getting, 1,000. All the market rent is $1,000 a month per unit. Well, that's pretty tight. You may not qualify for that based on what the debt to income ratio is based on that property and what that property's cash flow would be after they're rented. So those are the things that we're going to look at. So you would want to be a good investor in good standings with your credit report. Obviously, the better credit, the better deal you're going to get. And that's in my world anyways, in most people's worlds, that's common sense in a sense that, better my credit is, the better options I'm going to get, right? The less risk.
Despite the rumors that were going around a while ago.
Yeah, the rumors that we talked about last week where people with bad credit are going to get better deals with people with good credit, and we debunked that, right?
Yes.
People with good credit are always going to get a better deal than people with bad credit. So it's kind of goes here. So if you're an investor or you're looking to buy an investment property, especially here, we live in Florida, there's a lot of people that buy investment properties, a great market to buy investment properties, but I see a lot of people, I have a lot of investors who buy in the cities up in Boston, and some of these other cities, Worcester, Providence, a lot of college towns, stuff like that. I mean, you can buy a house. I have a son going to Tallahassee. I got a son going to Worcester State, to Florida State University. And I'm thinking of buying him a home for his second year. Then I'm renting it out if I can find the right property, and renting it out to his friends, renting the rooms out. So, I'm going to have to put 20% down. I'm going to have some skin in the game. I'm going to have to make sure that house is producing enough income to support the debt, so I'm not coming out of pocket. So these are things that you want to look at, and that's why it's important to have a good plan. So when you're looking at these houses, you want to look at what your rate of return is going to be based on what the rent rolls are, based on the market rent. It's what's difficult for a lot of these companies, or investors, I should say, to look at, is a lot of people are Airbnb-ing these properties. So that's not going to be you can't go off what the Airbnb rental is, because it's not stable enough to know that you're going to rent that out 80% of the time at $300 a night, right? So you can't say that this 1 unit property is going to make, $9,000 a month in rent. What is the monthly market rent roll? So you have to look at that.
Well, I know that's going to be a question, especially in our area, because it's such a huge vacation destination. It's funny you say that, because I was literally just thinking of asking that. So for clarification, you're going, or not you, but the bank is going to be looking at what would if you had like a long-term renter in for like a normal period, like a year.
It could be a short term. It's just, what is that market rent? What is that 1,800 square foot house? What is the market rent for a 3-bedroom, 2-bath, 1,800 square foot house getting in Manatee County and West County, Mass, per month?
Instead of like a short-term.
Correct. Because it's not a stable enough index. And I think there are some programs out there that are considering, because Airbnb is a big deal now. And a lot of these vacation areas, they make money. But again, wise investment. I mean, that house, again, you're buying a house by the beach that's going to make you $300 a night, 80% of the time, call it $8,000-$9,000 a month. You're going to be paying $1 million+ for that. So even the monthly rent would probably be around $5,000 or $6,000 a month for the right size house, close to those amenities, if you will, the beach and just a high trafficked vacation area, if you will. So we look at the whole thing. The best thing is to give us a call, or give another bank that does these DSCR, debt service coverage ratio loans. And, it's an option for you where you're not looking for that hard money guy or knowing those connections of those investors who actually lend people money on projects like this. I mean, a lot of investors have their own people. This is for somebody who doesn't. These programs are available and they're competitive in rate, and the cost up front is very short, but it also just evens out the playing ground for people like you and I to go out there and buy a property or two for our portfolio. The world's a lot different now. In my industry, I fortunately have a 401k, but back in the day, everybody had some kind of a retirement plan where they work. A lot of people don't have that right now. So they're looking at things like real estate to be their end game, in their years of retirement. Cause you can win with real estate. You own a couple properties that you rent out, and, between that and Social Security, but you just didn't have a real avenue to get to that money before. And there are solutions out there. So that's really what I want to talk about. Guys, I really love that you guys are joining us. And I know this is, it's a little bit more complicated subject than a quick 15 or 20-minute call. So you can always reach out to us and we can kind of go a little bit more in depth, but let's just wrap this up in a way that I keep it very clean and simple, right? The debt service coverage ratio loan is going to look at the property and the income and cash flow that property produces to see if it supports the debt. The second piece of it is you have to have a good credit ratio, is a good credit score yourself to back that up. And if those two things fit, then this is a great solution for you to be a property investor and have a rental income coming.
Chris, thanks for talking to us about this this week, because we say it all the time and people know it. Real estate is one of the best investments that someone can make. Right. And, the people that are just starting to think about this, my generation, right? The millennial generation, the reality for us, economic reality is for us today is not what it was in previous generations. And this loan bridges that gap. So this is awesome.
And reach out to us. We'd love, keep those questions coming in. You given us, this came in from a real estate agent that was asking for one of their investors. We love for you guys to give us some input on what you guys want to know, and any questions that you have that we can talk and really pinpoint on. So we thank you. Please, like this on YouTube, follow me on TikTok, Facebook, Twitter. I got them all, guys. Just look me up. Just follow me up, follow me, follow this podcast. I mean, it really helps us get the word out there. And hopefully if you find value of it, you can share it with someone else that would find value of it. And
that's right.
We would greatly appreciate it.
And if this episode was like drinking from a fire hose, you can always watch or listen to it later on YouTube to get all those details. That's Chris Scally Mortgage Dreams is where you'll find that. So Chris, thanks so much for being here today. Thanks for sharing this with us. And we'll be back live again with another topic.
Awesome. Thank you, guys. Good seeing you.
Bye.
Have a great week. Bye now.